Todd Barlow, CEO and MD of Pattinson. Welcome to TMS Insights.
Thanks very much for having me.
Thanks for your time. Good time to be CEO after record results, Todd.
Yeah, absolutely. Yeah, we had all of our major companies giving us an improved contribution on the prior year, but the most material was clearly New Hope with a turnaround in the coal price, so that helped a lot. Our regular profit, which is the thing that we look at as the underlying basis of our business, was up 60%, but the statutory profit was up more than double. So the big non-regular gainers for us was our investment in Hunter Hall and Pengana, which we merged and pretty much doubled our money in the last 12 months on that. So that was a good profit for us. Yeah,
no, excellent. And Todd, you've been in the role for a little over 3 years, but a long time with Pitt Capital Partners.
Yep.
How are you enjoying it?
Yeah, I mean, it's been a great group to be involved with, and 10 years advising the group in their investment bank.
Yeah.
3 years as the CEO of the group, which has been a fantastic experience. I think we've achieved a lot in the last 3 years. We went from circa 8,000 shareholders when I joined to about 18,000 today, and that number increased 20% in the last 12 months alone. The other thing that I think has changed a lot is the market interest in the stock. We've had daily liquidity increase about 8 times in that 3 years. So the benefit of that, of course, is we've been able to go in the ASX 300 index in March, and then just last week we went into the ASX 200.
Yeah, no, wonderful. And all that's come on the back of a prolonged history of performance, really, from Pats going back to over 120 years ago.
Yeah, absolutely. Yeah, I mean, one of the things that I can talk about some of the short-term things that we've been able to achieve, but one of the things that constantly amazes me is just the long-term growth of the total shareholder wealth over. I mean, we put up stats there for the last 40 years, and that indicates 16.8% growth year on year for 40 years. So $1,000 in 1977 is worth nearly $500,000 today, which is just extraordinary growth.
Outstanding. The reality of it is that opportunities exist all the time, don't they?
Yeah. Absolutely. I mean, even we have such a short-term focused market that you do something and people forget about it 6 months on and they don't want to talk about it anymore. But March 2016, so just over 18 or about 18 months ago, we deployed $900 million into a coal asset, which was really bottom of the market stuff. It was the coal price was below $50. It's recovered now to nearly $100. And the market was sort of turning off coal, but now everyone's quite interested in it again, and it's made a lot of money for us in the last 12 months alone.
Okay, and moving on to Brickworks, a good result. There were factors again, I guess. Cyclone Debbie was an issue. WA is still pretty flat. Yep. But it was a good result.
Yeah, I mean, it was a record result, helped a lot by the contribution from Pattinson. The building products result was a little bit off, but as you said, that was related to a couple of key issues, which I don't think will be repeated, and Cyclone Debbie was an issue. The headwinds for the business in the future are the higher energy prices, but because we're getting so much demand at the moment for the products, the price rises are quite effective at passing on some of the increases to the input costs.
And the property trust has grown into something really substantial.
Yeah, that's another key feature of Brickworks' result, was the further land sales into the trust. The trust value to Brickworks, the equity value is circa $500 million. And the other thing that's really interesting about the trust is the dividends that they get from the trust are now quite sustainable and growing because you get sort of CPI or more increases to rents. So the great benefit of the property trust and Brickworks' investment in Sols is that those two things virtually underwrite the Brickworks dividend going forward.
Switching pace, TPG. It was a tough year. How would you describe TPG's positioning right now?
We're actually quite, as you'd expect from our side of the fence, counterintuitively quite excited about TPG. The share price has halved in the last 12 months, but we think that would be a little bit like saying that Amazon should get marked down in the retail sector. Right. I mean, Amazon's the disruptor in the retail sector, and I think TPG is the disruptor in the telco sector. So the problems that are happening to the telco sector are the problems for everybody else but TPG, because TPG is the lowest cost operator of broadband, and as people migrate to NBN, it becomes a level playing field. So really it comes down to what is your cost of administration, support, billing on top of the NBN charges, and I think that being low cost, TPG will always be able to offer either the cheapest plan or the highest margin product.
If you look back a year or so ago when the share price was double today's price, more or less, is it fair to say the market underestimated the difficulties of the NBN?
I think they did. I think there was a perception that it could continue to grow in a way that it was growing, and that was obviously going to stop when NBN started to kick in. But then I think the market's gone too far the other way now, and they're very pessimistic about the entire sector. And we have to have a profitable telecommunications sector. That's the reality of it, and it's a sector that's growing. I mean, people's consumption of data and voice is growing all the time. So we like the sector. It's just a matter of finding the right way to make good money, and I think mobile is definitely a really good move. How
long does a shareholder wait? Sold Pat's, decades maybe, but for the TPG retail shareholder, what's the 3 years?
Yeah, I don't think you have to wait until. It's sort of a circa 3-year period before TPG physically starts getting revenue from its mobile entry. But as you know, in markets, you don't necessarily need to wait until the revenue occurs. The market will start seeing that TPG is effectively rolling out its platform and its network. It's doing so in a cost-effective way, and the capex is not blowing out. And I think you'll start to see some re-rating of the stock as it gets closer to the date when it can start attracting customers. But in the meantime, if you look at the price today, it's sort of 10, 11 times PE stock. You're not having to take a big punt on the future. You're getting a pretty good valuation right now.
Yeah, and the lower dividend that TPG paid to Sols, etc., made up through the various other increases and the New Hope extra contribution, for example? Yeah,
that's a key point, because it's something that we value very highly, is the consistency of our dividend, and this year was the 17th straight year of increased dividend, which is something we're very proud of.
Brilliant.
And the reduction that we saw from TPG, whilst we think it's a very positive thing that they're reinvesting in their business, and it should be distinguished from the other dividend cuts that people are having because their earnings are coming off. We think it's a good thing.
Such as Telstra?
Yes, absolutely. Yeah. So we think it's a good thing that TPG is cutting its dividend, but it does create an issue for us from a Sols perspective, that we need to manage our cash receipts so that we can ensure we pay higher dividends. And we're lucky because New Hope is a much more stable and much higher cash contributor these days, and we think we'll be able to manage ourselves to make sure we keep increasing the dividend.
Shareholders will love to hear that. That's great. And Todd, so through the year, a couple of sales of some listed equities, ANZ, Telstra, but you're still holding things like Commonwealth Bank, NAB, Woolworths, Wesfarmers. Any comments there? Telstra?
Telstra, I think is different. We're taking a view that it is going to be challenged by TPG. TPG's entry into the mobile market, as I said before, is going to be very disruptive to the telco sector, and I think all of them will suffer, but certainly Telstra will as well.
Todd, financial services, that seems to be, it's got a bit of the Todd Barlow stamp of the really new part of the business that's growing.
Yep.
Obviously, I'd love you to talk us through the Hunter Hall deal, which happened over Christmas last year, which to me, again, just shows the value of the reputation of Soul Patts. Peter Hall choosing to sell to a trusted buyer than perhaps at a higher price to somebody else.
Yeah, I think you raise a really good point about the way that we try to utilise our reputation to the benefit of our shareholders, because we see a lot of opportunities, and that's A, because we're active in the market, but B, because we have the type of capital that is very flexible, and there's not very many of our competitors who would do the type of deals that we do. But in addition to that, there's lots of people who want us to be on their register. They like the way that we're a supportive shareholder, the way that we're long-term, the way that we'll let them get on with their business, and we just pick good managers to run the business, and we're happy to support them with capital along the way if there's growth opportunities. But otherwise, we're quite happy to keep businesses going as they are. And for us, it's more a thematic play. So we picked financial services because we don't see a lot of themes at the moment which are attractively priced. They're either challenged, either from a regulatory perspective or technological perspective, or alternatively, they're not challenged by any of those things and the prices are extremely high. So it's quite difficult for us to deploy funds at the moment, but we still do get the occasional opportunistic transaction where people want us to come and assist them with a transaction or come on their register, whether it's somebody's retiring or wanting to leave for some reason. So we jump at those opportunities. So this was a nice convergence of a great opportunity in an industry that we really like at an attractive price. So when Peter Hall decided that he wanted to retire and wanted to give his shareholding to somebody who was going to be a good custodian, then that worked really well for us. And then we realised that we happened to at the same time be transacting with on the Pengana transaction, and we worked out that there was a really nice fit between those companies. So it all came together really nicely for us.
And property, finally, I guess, Todd, 160 Pitt Street. You were looking to go to market. Did anything ever happen there?
We're still interested in looking at options for the property, as we are with all of our assets, not just property assets. We're continually looking at ways that we can enhance value. So we went to market to see what it was worth, and it's a very interesting asset in a very prime location. So it's not an easy decision about what we do, because there's potentially some development opportunities or some leasing opportunities. So it's a more complex asset than some of the other things that we have. So we're weighing it all up at the moment.
Is there a number you've got in mind for that?
There probably is, yeah.
Cagey, but always very confident. Todd, thanks very much for your time today, and congratulations on a great 17 result.
Appreciate it. Thanks for your time.